Hello everyone, and welcome to today's webinar, Cyber Risks Looming in the Transportation Industry. I'm Andrea Terrell, Marketing Director at HNI, sitting down with Kevin Zinter, the Senior VP from Amwins. So a few housekeeping items before we get started. One of the first questions that we always get is if we're going to share the slide deck, and yes, we'll be posting that to our website along with a recording on hni.com. We'll email you all a link to access this after the webinar. We will be doing Q&A at the end, but feel free to ask questions throughout. You can ask questions by typing it into the chat window in your GoToMeeting control panel. You can also tweet at HNI Risk or use the hashtag HNI U, and you'll be entered to win some HNI swag. Just wanted to say a quick thank you to our sponsors. Because of them, we're able to put on this workshop and webinar series. So a little bit about Kevin, our subject matter expert today. He's worked with Amwins, the largest wholesaler in the U.S., for 9 years. He specializes in financial services lines, including D&O, E&O, and cyber liability. He works across all industries, but lately has been working a lot with transportation, as this is an emerging risk in our industry. And he is a graduate of U of I, the University of Illinois. So Kevin, I'll hand it over to you to take it from here.
Thanks. Thanks everyone for taking the time to dial in today. We've got a presentation put together that we're going to run through, hitting on a couple of different topics here. We're going to go through a review of exposures facing the transportation industry, a review of Wisconsin state laws as well as the federal landscape, and then going into how an actual cyber liability policy is brokered, what it looks like, what the insuring agreements spell out, some stats, some sample claims, and basically what kind of risk management services are behind the cyber policy that helps you all sell it to your clients. So we'll start. Okay. First slide here is talking about the various exposures facing the transportation industry. Basically, any risk, whatever industry class it's in, is going to be collecting a lot of personal information in different facets. With trucking firms and transportation firms, there's a lot of employment information on their own employees, prospective hires, vendors, customers. There's health information, financial, social security, identity information, etc. But beyond just that, I think transportation firms and trucking firms are looking closely at who they share this information with, how they're exchanging it, and what they're doing with it, what kind of vendors it's being shared with, providers, outsourced firms, as well as pharmacies, clinics, doctors, research partners, financial services institutions, etc. So beyond just your four walls, it's the sharing of that confidential information to outside individuals and what are they doing with it.
So Kevin, for some of the transportation companies on the line, recruiting and retention is obviously a big priority for them. Do you see the collection of applicant information, maybe storing resumes, addresses, phone numbers, do you see that as an exposure?
Yeah, definitely. It's basically Wisconsin state law and most other state laws define a confidential record as a last name coupled with a first initial, as well as one other confidential piece of information like a social security number, an account number, or something like that. So if you're looking at potential hires or your own employees and maybe actually going through a large volume of applicants and collecting it, storing it, but maybe not eventually hiring those people, you are collecting that information and storing it in your archives or in your offices or online or something like that, which can lead to a volume of information that could eventually be lost, and then an obligation to notify those people that their confidential info was lost. There's also a rising concern with the transportation industry in holding confidential business information, including trade secrets of your own or actually third parties. So trucking firms that may be hauling certain loads or being entrusted to carry certain items that really shouldn't be out in the public or shouldn't be out being disclosed can actually be released or lost accidentally. So cyber liability policy doesn't just cover the loss of individuals' confidential information, but it actually covers the loss of trade secrets or business secrets. So, but basically there's a lot of different exposures facing this industry right now, and it's important to take a look and understand who you're giving your confidential information to. A lot of transportation firms use logistics providers and freight brokers, so I think it's important to understand, do those individuals safeguard your data? Most situations, if it's your data that's lost by a third party, a cyber policy is still going to respond, but every situation is a little bit different, so it's important to look at your contracts and understand who has your confidential information. We've got a little bit of a write-up on the federal landscape, but basically there are 47 of the 50 U.S. states require some kind of, or have some kind of privacy law in place aimed at notification and safeguarding data. There's still 3 U.S. states that don't have something. Kentucky was the last to just put something in place. There's a pretty complicated patchwork of federal laws that also look to govern this. HIPAA, FERPA, and the Children's Online Privacy Protection Act are probably the 3 most popular out there, but essentially the federal landscape has become pretty complicated to navigate and understand who you're sort of subject to in any given situation, and each of these regulatory bodies sort of reserves its right to bring an investigation depending on the exact circumstances. So navigating the federal landscape has become increasingly complex. On the state level, we took a little bit of a look at Wisconsin. Wisconsin and the surrounding upper Midwest states all have their own individual laws, but basically Wisconsin outlines the definition of a security breach and defines what constitutes a breach. Basically it just says that an entity that has lost confidential information of a Wisconsin resident, and then it goes on to define the notification obligations. What's interesting about Wisconsin is an entity who's lost confidential information of Wisconsin residents needs to notify them within 45 days after the entity learns of this event, which is pretty tight wording. If you look at all the individual state laws out there, most of them don't have any kind of trigger on the number of days after you learn that this has happened, but Wisconsin is particularly tight on trying to enforce a 45-day window. The one caveat to this law is the entity does not need to provide notice if they believe that there's not a material risk of identity theft or fraud, which is usually pretty hard to discern that right away, but that is technically in there. Wisconsin law doesn't outline particular penalties that can be enforced, which doesn't necessarily mean anything. It just sort of gives the Attorney General or the lawmakers a little bit more freedom or wiggle room. Within Wisconsin, you don't technically need to notify the Attorney General if you've had a security breach or a privacy loss, but you do need to make notice to all consumer reporting agencies and credit bureaus if more than 1,000 residents are to be notified. So the most important thing when you're looking at state laws governing privacy is that it goes by where the consumer is located, not where the business is located. So if any firm or a trucking firm has lost applicants' info in Illinois, Missouri, Iowa, Indiana, Wisconsin, you're actually subject to each state's individual laws and not just the state where the business is domiciled. So what this has sort of created is sort of a cottage industry of attorney firms who specialize in understanding and navigating the landscape of all these laws and sort of keeping all the individual state attorney generals happy. We've seen a number of cases where one state has a pretty small amount of records lost in a larger data breach, and that state attorney general gets a lot more active than maybe a larger state who has a lot more affected individuals in it. So it's sort of difficult to understand where the regulatory actions are going to come from in any given privacy breach.
And just a quick note for the folks on the phone. We wanted to share an example of Wisconsin just to kind of illustrate what some of the state laws can look like. If you're located outside of Wisconsin, feel free to reach out to us and we can clarify what the requirements are for your state.
When you get into actually brokering a cyber liability policy, there's two main distinctions to understand. One is first-party risk and the other is third-party risk. Third-party is what you know and understand when someone brings a lawsuit against you alleging negligence in safeguarding confidential information, negligence in preventing a privacy loss, something along those lines, defense expenses, the resulting settlement that comes out of it. What's most important about a cyber liability policy, though, is first-party costs and expenses. That's the direct loss incurred by an insured. Usually, I think about 8 or 9 times out of 10, there's actually not a third-party lawsuit accompanying a privacy breach. It's actually just the first-party expenses are incurred even without a third-party loss. For a cyber liability policy to respond, you don't actually need a third-party lawsuit. In fact, most of the time, there's just some smaller amount of money spent trying to fix the problem, trying to understand the problem, hiring a forensic expert to root out where the virus or attack occurred, and determining how deep the breach or attack really was. Within first-party costs, that includes forensic expenses, crisis management, and PR expenses to sort of manage the risk in the news media, as well as the cost to notify people and offer them a potential offering of credit monitoring. So that's by far the biggest premium driver within any actual quote or policy. The next couple slides go through the basic insuring agreements with any cyber liability form. The first one has a lot of different names to it. It can be called privacy liability, security liability, cyber liability, privacy injury, and that's kind of one of the biggest troubles when you're brokering the actual placements of these policies is the complete difference in terminology from carrier to carrier. There's really no standard or ISO form when it comes to this line of coverage. But the first one is essentially the third-party claims alleging the insured's failure to protect confidential information or failure to protect trade secrets or any kind of proprietary info that was lost. Whether it's through a network and information security failure, a mistake, internal rogue employees, or just some kind of accidental loss. It's that lawsuit that's being brought against you alleging damages, pain, and suffering. The second one, notification costs, can often be combined with the third and fourth insuring agreement that we'll see, but notification costs is sort of the hot button sublimit and usually the main premium driver within a deal. When someone's information is lost, depending on the state law, there's oftentimes an obligation to notify those people that something has happened, and we may or may not also be offering you credit monitoring to go along with this breach. The biggest incidents that we read about involve 40, 50 million in lost records, and there is a dollar cost to notify all those people that something has happened. The carrier will cover the cost to write the letter, the ink, the postage, the stamp, and that's usually about $2 to $4 a record just for that ink, postage, and paper to let those individuals know that their information was lost. Some forms will also cover a remediation service to actually repair an insured's credit, but that's something that can be brokered. The third one, like I said, is oftentimes combined with notification costs depending on the individual carrier's policy form, but it's probably the second biggest premium driver within a particular quote, and that's crisis management and forensic expenses. When a situation hits the news media, some are handled well and some are handled very poorly. If you look at the Target breach, they were perhaps a little bit late in trying to convince the public that everything was okay and that they were on top of it, and it really was sort of a media disaster for them. But it's the cost to hire a crisis management firm to come in and sort of give best advice and take out notices in the paper and on the news and help manage the insured's brand out there in the face of a breach or situation. Usually combined with forensic expenses, which is the cost for an outside firm to come in and root around in the system and determine where the breach happened, how deep it was, and what was affected. Forensic expenses, usually done on a billable hours basis, can be extremely expensive depending how sophisticated the attack was. We've seen breaches that forensic experts have only racked up about 3 hours worth and have been done, falling well beneath the retention. And we've seen attacks where forensic expenses have blown an entire 10 million limit. So that's increasingly something that needs to be negotiated to an appropriate limit within the policy. The fourth one, we were discussing regulatory defense. Most forms cover regulatory defense as well as the resulting fines and penalties. Some cyber liability policy forms don't actually cover the penalties that can come out of this, so that's something that you need to look at when you're brokering a deal. But a regulatory insuring agreement should not limit the particular regulatory agencies that can bring an action, because it's really sort of up in the air where it may come from. It may come from the state attorney general level. It may come from HIPAA or FERPA, or really anywhere. So it's extremely expensive to respond to the inquiries as they come in. Oftentimes we see these regulatory investigations going on for months and months and months while lawmakers and regulatory offices try to determine what has happened and how it happened. And usually what they're trying to do is go after the weakest of the situations. They're not probably going to go after someone that had extreme encryption levels in place and really was taking every possible measure to prevent an attack, and then something happened. They're usually going after someone that was really, really negligent. That's sort of the low-hanging fruit and the easiest targets for them. The resulting fines and penalties we've seen all over the board, from 5 figures to 7 figures. It's sort of difficult to peg where they're going to come in, but usually the average regulatory fine or penalty is about $150,000 once it does come in. Extortion is something that we haven't seen too many incidents out in the news media about. They're usually kept a little bit more quiet, but if somebody hacks into your system and tries to extort perhaps a monetary amount out of you, threatening to disclose confidential information or threatening to take you down, take your system down, the policy would cover the expenses to deal with that, and possibly, depending on the carrier, the resulting payment that was made to the extortionist.
So Kevin, to clarify, if you're kind of being held hostage by an extortionist, paying them off might be covered under your cyber policy?
Yeah, it does depend. It does depend on which insurance company that the program was placed with. Some don't cover those, but some forms do, depending if it was brokered sort of up front. But usually that's sublimated to an even smaller number within the extortion insuring agreement. We've seen actually a lot of relatively low extortion demands. We've seen extortionists hacking into someone's system and then actually asking for a really small amount of only maybe $500 to clear out of the system and sort of leave the victim alone, which is interesting because for $500 most people will pay that and not even report it to the FBI and just try to move on with their life. So we've seen extortionists making large demands, and we've seen them making very small, almost a dozen a day attacks at only $500 at a time. So it seems to be on the rise.
Interesting.
Business interruption is something that can be quoted. It's probably the least purchased of all the insuring agreements within a cyber policy, but it covers downtime and the cost to try and get back online for a business due to a breach of a company's network. So we're not covering typical business interruption losses that may be covered under a property policy like earthquake, fire, flood, something like that. This is really just the insured going down due to a denial of service attack, a phishing attack, something like that. The different carriers forms that are out there, some cover your actual loss of revenue during the downtime, and some just cover the cost to try and get back online. So it's another sort of difference in carriers' policy forms. Media content, probably most relevant for retailers or online companies, but really applicable to anyone. Covers libel, slander, and other forms of disparagement due to the display of material. A well-written media insuring agreement would also respond to social media exposures. So if you have a company who has a official Twitter account and someone goes on the Twitter account, perhaps in the media department, and makes disparaging statements about a competitor or maybe a vendor that they work with, and that vendor or competitor brings a lawsuit against them. We've seen a couple of those out in the marketplace. Pretty interesting. They're usually kind of all over the map on how they come in, but can be pretty damaging.
Kevin, have you seen any policies or situations that maybe comments by a rogue employee on their own personal account could be covered under a cyber policy?
Yeah, if the media insuring agreement has a certain grant towards social media, usually the policy will say, without sort of that additional coverage grant, will say it's only covering media under the insured's direct control or on the insured's official website. But if you sort of ask for an endorsement, it would cover media that's not just under the insured's direct control, which would be an individual's personal Twitter account or an individual's private Facebook account, which we've seen a couple examples of that too. Someone goes home during their downtime and puts something on Facebook, makes some disparaging comment, and it's sort of off the clock on personal time, that could be covered. And there's actually a lot of policy forms out there that directly exclude that because it's very difficult for an underwriter to try and underwrite to that. How can I know what someone in the media department or IT department is going to do on their downtime and go home and tweet or Facebook about? So commonly excluded, but can be brokered to get an affirmative coverage grant. Hacker damage is another item that can be covered under most cyber liability policy forms, and that's the cost to repair or restore damaged or destroyed data that the insured had in their possession to the state that it was in previously. So if the insured needs to restore maybe contracts or employment information or W-2s or logistical routes, anything like that that needs to be restored in order for them to continue on with their business, this would cover the cost to the additional man hours and the time spent and the wages spent to try and restore that data. PCI fines and penalties is something, again, maybe a little bit more relevant to a retailer, someone that takes a large volume of credit cards. Essentially, the payment card industry governs the privacy controls surrounding the usage of credit cards. What's interesting about PCI is they sort of do an investigation. They bring a fine against an insured that they feel was not using appropriate security controls or standards in the accepting and usage of credit cards. And what's difficult is for an insured to try and fight that fine. It seems almost impossible for an insured to appeal that and get out of it. Usually PCI is, again, coming after people that are really, really negligent in using and accepting credit cards. So, for example, when you purchase something in a store and you get your receipt, the 16 digits on your credit card are usually listed as all X's on your receipt, except for maybe the last 4 to indicate that it was you that made that purchase. If a retailer or someone maybe just listed all the digits of the credit card on a receipt, that would sort of be a violation of PCI.
So if, for example, if a company were to use a form where you had to enter, name, credit card number on a piece of paper that you fax in or email in, do you see that as a big risk?
If that information was not sort of destroyed or kept confidential afterwards, it could be construed. But if you're just sort of taking the order on a piece of paper and you have to write down your credit card on a piece of paper, that's not necessarily a violation of it. It's sort of how you then safeguard that going forward. Or if you gave a receipt to that person based on the information that they put on that piece of paper and the receipt still listed all of their information, that would be more along the lines of a transportation. So those are basically the insuring agreements within a form. Some are combined and sort of melded together, and others are listed out separately, usually under completely different terminology, depending on the carrier. But what's difficult about cyber liability in its growing form is why is it not covered elsewhere? So the next two slides kind of go into why it's not covered elsewhere. And there's a debate to each of these, depending on the exact situation, about maybe trying to push a cyber claim into certain coverages. But I think the number one thing to look at on why cyber is not covered under GL or property or E&O or D&O or crime is the first-party insuring agreements that we're discussing. That's the cost of notification, forensic expenses, crisis management, public relations costs. If you look at GL, GL is designed to cover bodily injury and property damage and not really stolen identities. Property may cover the cost of a destroyed computer, destroyed laptop, that actual hardware, but it's not really covering, again, the stolen identities, nor is it covering the forensic expenses or notification costs or the third-party lawsuit coming against you. E&O policies or professional liability are designed to cover services for others for a fee. The intent of that policy is to cover a mistake, error, or omission in the course of the company's professional services. So you could argue in certain situations that in the course of their professional services they caused a privacy breach due to some mistake or omission or negligent act. But really, again, you're going to come back to that first-party issue. An E&O policy doesn't cover all those other sort of bells and whistles of a privacy policy. D&O, we've seen cases where certain public companies will see a fall in their stock tied to a known cyber incident in the media, and there may be some argument to put the cyber liability with the same carrier that is doing the D&O. But D&O is really for directors and officers' fiduciary duty in running the company. You may see the stock drop and shareholders get active because of maybe a target's failure to sort of handle the situation appropriately. But again, D&O is not going to cover first-party expenses associated with a breach. We hit on media. And again, crime covers employee theft of money, securities, and property. A data record can be stolen, but you're not really going to see a financial loss come out of that. And crime, again, does not have the bells and whistles of a cyber policy. There's some overlap, perhaps, for electronic fund transfer losses and things like that. And we're starting to see a little bit more melding of those two coverages. Cyber carriers trying to throw in certain crime insuring agreements, but that's probably the closest to an argument. Again, if you look at individual carriers' policy forms, the terminology is totally different on what each one calls their various insuring agreements. So this little chart tries to sort of match up a few carriers' forms out there and why they're all different. Each carrier has a different approach at underwriting. We see some carriers that rate almost completely off of record count. And all they want to know is how many records do you have, how many records are in your systems, and that's really their main rating tool. We have others that don't really look at that quite as closely and just look at revenues and assets and take a mix of security controls and class of business. So on any given deal, you're going to see probably a pretty widespread variance in pricing and terms and conditions depending on the carrier and the underwriter. Next couple slides have sort of brokering challenges, exclusions to watch out for. Some forms are very cheap and offer very competitive pricing, but are full of holes and exclusions that we think would pretty much not cover almost any claim or incident out there. And probably the biggest one to watch out for is losses arising out of unencrypted portable devices. So a laptop or an iPhone or a flash drive or something that was lost and wasn't encrypted, it's kind of doomsday for a carrier, and it's usually addressed in the underwriting process, but pretty difficult to sell a policy that has that exclusion on there. considering how many losses of unencrypted portable devices we see. Another big one to watch out for is notice of claim timing. Are you required to report a claim within a certain number of days of the actual incident? If you look at Target and Home Depot and some of the big ones out there right now, these incidents happened 5, 6, 8 months before they were even disclosed publicly. With such exclusionary wording, you would see those claims completely denied. Home Depot's breach, it sounds like, started in April. We've just recently heard about that one. You wouldn't want sort of the notice of claim timing kicking these out, even during an active bound policy term, the carrier telling you it's not covered. As these hacks become more criminal and sophisticated in nature, arising out of Eastern Europe or China, we see actually a lot of insureds not even discovering these for some number of months after they've happened. Stacking of retentions is something else to watch out for with all the different insuring agreements we went through. If you hit a couple different insuring agreements on one individual claim, you don't want to pay your retention maybe 4 times. You'd want the policy to read you're just going to pay the highest applicable retention that was triggered. You don't want to pay, say, a $25,000 retention 4 times because you've hit 4 different insuring agreements. We've got a couple other ones in here, and there's one last one I hit on this slide is the failure to update antivirus and maintain security levels referenced on the application. That's a little bit big brotherish for a carrier to say, if you start carrying certain controls to a lesser extent than what you originally told us about, we're going to deny your claim if something happened because of that. See a lot of insureds perhaps struggling with resources to give to IT. If IT decides they have to maybe downsize or do things a little bit tighter, and a claim happens out of that, you don't want the cyber carrier referencing what was put in the application and denying a claim. Which is sort of the next one on this slide as well. Those are all sort of along those lines. A couple other common ones that you'll see are wear and tear, drop in performance, or aging of electronic equipment. You don't probably want to have those within your forms. If something becomes a little bit outdated but it's still being used, again, due to financial resources being somewhat limited, it's sort of pretty gray in how a carrier can determine that equipment has deteriorated without sort of a metric to understand that. It gives a lot of room to deny a claim. Again, to hit on regulatory, a lot of regulatory forms cover just the defense expenses or even just the proceeding expenses. Within reg, there's kind of 3 different areas. There's the proceeding expenses, which is actually sitting through a proceeding in court. There's the investigative expenses, and then there's the fines and penalties. Some forms cover only the investigation expenses, some cover only the proceeding expenses, and some don't cover the fines and penalties at all. So understanding what you have in that insuring agreement is important. The next couple pages give a couple stats on incidents over time. If you look at 2007 and 2008, we saw a pretty big jump in the number of incidents, and these are generally incidents that are only reported in the news media, not private incidents that never sort of made it out there, or these aren't necessarily carriers' actuarial data. But what happened from 2008 to 2009 is sort of the time when a lot of big incidents were hitting the media, and there was a lot of backlash against executives and entities for not being more careful. And what kind of happened around that time is they started refusing to publicly disclose what had happened and refusing to notify individuals, and we saw a lot of new state laws getting drafted. That probably explains some of the drop from 2008 to 2009 as regulatory oversight and state laws started to get a little bit more aggressive. In 2010, we see it climb back up by 2011 as these incidents never really went away. They just kind of stopped being publicly disclosed. Hit the high point in 2012. What's interesting, if you look at this chart as it continues to be updated, we still see claims being disclosed today that happened in 2012 or 2013. So these numbers kind of continue to tick upward, and 2014 should surpass 2013. And what's also interesting about this is, again, these are just incidents reported in the news. One leading carrier, Beasley, told us recently that they've personally handled over 600 breaches this year alone. So if you look at 2014 on our graph, that's 615 in the news, but one carrier has actually handled 600 this year alone. So those numbers are actually a lot higher if you had access to carriers' actuarial data. The next two slides give a look at incidents by breach type all time. All time on this page we see hack is at the biggest piece of the pie at 31%. Stolen laptop, I think next highest at 11%. But if we flip to the next page, a look at just 2013, we see that hack is actually 47%. So from maybe the last couple years leading up to 2013, a lot of these incidents were accidental. Employees' mistakes, maybe a lack of education, leaving laptops in Starbucks and they were getting swiped. 2013 is sort of the rise of the criminals coming out of Russia and Ukraine and Eastern Europe and China. We see a huge increase in criminal activity. Again, we see in 2013 alone, outside accounted for almost 64% of all incidents. Inside accidental at 15% used to be a much bigger piece of the pie. And actually inside malicious, that rogue employee, depending on how that action happened, could be covered, but that's still at 11%. One other thing that heard recently in a study is a couple years ago, if your data had been lost in a privacy breach, if it had been lost in a privacy breach, you had about a 3 in 10 chance of it being used fraudulently. That number is much more on the rise. We heard last year that number is a lot higher now. So if people are stealing your data or if it's being lost, it actually seems to be being used fraudulently a lot more now. The most recent study that we look closely at, the net diligence study, the average claim is about $3.5 million if it does get reported and brought to a carrier. Defense and settlement, the attorneys are still getting a huge piece of that pie. Defense costs are extremely expensive, huge billable hours. Settlement, that number at $300,000 is actually a little bit lower from the previous year's study, and that's dictated mostly by a couple really, really large settlements that we saw in 2012 that drove that number higher. So that actually fell a little bit just in the absence of a couple large settlements. But those crisis services that we talked about being a premium driver within a deal are still a huge chunk of the average claim. Forensics, notification, credit monitoring, accounting for almost $750,000. And again, those are about 8 times out of 10, those are really the only thing triggered under a particular loss. But the average PCI fine is about $50,000. The average regulatory fine is about $150,000. And the average per record notification cost, this number varies pretty widely, but it's about $3 to $5 or so per loss. And that's kind of the minute one cost of writing the letters and the notification and the postage and getting the letter out the door and letting people know what's happened. We talked about malicious attacks versus accidental attacks. Breaches involving that malicious malware or spyware are about 4.5 times more costly than a breach involving unintended accidental disclosure. If it's unintended or accidental, sometimes it's difficult to figure out what's actually happened. Where did the lost laptop go? Who has it? You know, it's difficult to track, but oftentimes the criminals are more sophisticated than even our firms here in the U.S., which is why those malicious attacks can be so expensive to root out and determine how deep they really went. So I think if you're speaking with a prospective buyer, there's a couple of questions to consider and talk over with them. to help them understand what their exposures are. How many records and what kind of records do they hold? Is it just on employees or prospective hires or customers or clients? Sometimes that number is really difficult to figure out, but it's a good process to try and understand. Do you hold any corporate information or trade secrets? Are you aware of the notice requirements in each of the states that you do business in? Again, it's not just the state where you're domiciled, it's the state where the affected individual resides in. What steps would you take? Who would you call if you lost private records? Do you have privacy policies, disaster plans, and how are your records stored? Do your employees have access to private records? Can anyone within the company gain access to this confidential information, or is it sort of walled off? Are any of your records or confidential information handled by a third party within the transportation realm, logistics providers or data destruction companies or freight brokers, things like that? Are you giving confidential information to them, and what do they do? How do they safeguard it? Additionally, there's a contractual requirement that's put into a lot of these contracts. If it's lost by a vendor, are they going to do the notification process, or are you? And I guess the next one is also quite important. Are your laptops and mobile devices encrypted? If they are, a lot of states say that if the data was lost but it wasn't in encrypted fashion, you don't need to do a notification. So that's important to understand. How much are you encrypting and where? I think the next slide goes into underwriting questions. These are actually similar to the previous two slides, but what do the underwriters actually look at? Again, we have underwriters that underwrite on completely different basis. On any given deal, you may have a quote that's 3 times higher than the next best quote, and it's really based on how closely underwriters delve into the information and what rating points they use. But these are sort of the nitty and gritty of what they look at. I think the next couple pages here, we've got a couple examples of the biggest breaches of all time, and then a couple that are a look at the transportation industry. But on here, on the biggest breaches of all time, many of these are just from the last year alone. Heartland is still probably the biggest a couple years back, but Target, Home Depot, eBay, and Adobe, pretty much all within the last year or two. Some of these had much smaller losses, but interesting because they've become sort of the standards for regulatory actions against certain bodies. We have a couple examples on the transportation industry. Corporate Car Online was a private limousine service that generally would ferry around wealthy individuals or celebrities or athletes. They were hacked into credit card numbers, expiration dates, names, and addresses on wealthy individuals. It was a pretty nasty loss for them. Probably suffered some kind of loss of income or people turning away from using them because of that. It was estimated that one had about 850,000 lost records. Houston Logistics was a New Jersey-based logistics firm. An unencrypted laptop was stolen from an employee's car. Contained just a spreadsheet on payroll information for current and former employees. That one came out at the end of last year. There's actually a number of examples involving the U.S. DOT or individual state DOTs. This one was a couple years back, but out of Washington, they had a pretty nasty loss of a laptop that resulted in about 130,000 people confidential information being lost, and someone actually was arrested, but I don't think the laptop was ever recovered, and a theft ring was believed to be behind much of that one. A couple examples here of sort of unnamed trucking firms behind larger losses due to truck doors swinging open and bits of confidential information coming out, which actually does happen. Allied Waste a couple years back in Boston. One in Burlington, Vermont. Laboratory Corp of America, a couple thousand medical documents fell out of the back of a truck bed while in transit. Actually had about 15, 20 years of medical information within them. So I think trucking firms need to understand what kind of information they're hauling. Again, what's in their contracts. If they lose the information in the back of their truck beds, if it's financial information on someone else, if they're hauling from maybe a medical clinic or something like that, what sort of contractual requirements do they have to notify? Is it on them, or is it on the creator of the data? Usually it's going to be on the creator of the data, but we've seen contracts worded either way, where the onus gets put on the trucking firm who's hauling it while it was in their care, custody, or control. Federal Reserve Bank of Dallas, another example. Truck driver lost thousands of bank checks headed to Houston. Again, the doors were not shut. Most of those checks weren't recovered. This one's a little bit more recent in Chicago. First American Bank made a public announcement basically informing people not to use credit cards when you take a taxi ride, which is something actually we've been hearing for a couple of years coming out of New York too, that this is a pretty easily breachable system depending on some of the card processing systems that the taxi cabs use, as well as maybe the individuals driving the taxi cabs. Sort of something to be aware of. This one is just kind of starting to get out there. A couple years back, we saw a group of Russian immigrants who were eventually arrested, but were using their hacking skills to basically hack into the Department of Transportation website and run a trucking company that didn't actually exist. They would sort of take control of certain loads and find another trucking company to deliver the cargo. The cargo would get delivered, and the hackers would contact the original cargo owners to get paid. The company that actually delivered the cargo would then contact the company the hackers were pretending to work for, and discovered that they had no clue really what had happened here. Hackers made off with about $500,000, but were eventually arrested. Lastly, just recently, the State Department is warning about a bug called Zombie Zero, which is coming out of China. There is a Chinese manufacturing company that creates a handheld scanner that's used by a lot of logistics companies that helps to track shipments as they're loaded and unloaded. It sounds like this Chinese company is actually purposely implementing this bug within the device that helps to steal corporate data as well as the manifests on these individual loads. So every time the scanner is used, it sort of uploads what's in the load, where is it going, and these thieves can use this to reroute or try and steal the inventories or loads, or simply understand U.S. supply chain relationships and routes. What's interesting about that one is it sounds like this actually might be funded by a Chinese hacking cell, sort of a state-run Chinese hacking cell is funding this this effort. So our summary page comes back to just a review of the different modules or insuring agreements within a policy. Security and privacy liability, the failure to protect confidential information, the failure of your network security. Media is libel, slander, disparagement. Regulatory coverage defines penalties and investigative costs incurred. And the key first-party coverages. Notification and credit monitoring expenses, crisis management, PR, forensics, extortion expenses, possible PCI fines and penalties, and business interruption costs. I think it's important when you're selling cyber liability to push the risk management services behind any given carrier's form. There's several different services out there that policyholders would get access to for free. The E-Risk Hub, Beasley's NoDataBreach.com, and there's a couple others, but I think these are really valuable as they give incident examples, white papers, best practice, guidelines, and access to professionals who can sort of do pre-penetration testing on an insured and give pre-breach advice. So I think it's important to understand those. I think the cyber liability purchase is sort of going towards buying not only a policy but buying sort of the risk management services behind it. Most insureds, if they've had a breach, have never had one before and don't really know what to do or how to proceed.
Okay, so we have a few minutes left before the end of the hour for questions. Again, if you have any questions that you'd like Kevin to answer, please type them into the chat window in your GoToMeeting control panel or tweet them at HNI Risk. So Kevin, first question. What do you see, kind of going back to the slide that you just talked through, what do you see as the highest cost area associated with cyber breaches? Is it data recovery, notification, loss of business, fines? Where does most of that cost come from?
I think a lot of that is going to be on the sort of the whole first-party crisis services, but a lot of this is sort of yet to be determined. There's not that much actuarial data out there because of how new this product really is. I think it's going to be a couple years until we really have enough underwriting and actuarial claim data to really understand all of these situations. But if anything, it may end up being the resulting loss to an insured's business because of negative publicity. How many people will stay away from going to a Target, stay away from going to a Home Depot, or telling their friends not to shop there because of something that's happened. So some of that will probably be impossible to quantify, but right now it's probably the crisis services that come out of it, and a lot of those are never really disclosed publicly.
So in one of the previous slides, you mentioned that about 47% of breaches are coming from malicious attacks versus human error. When it comes to risk management around cyber liability, which of those two things would you recommend that companies focus on? Either kind of beefing up their system to make them less susceptible to malicious attacks, or working to kind of mitigate that human error side of the equation?
Yeah, that's a good question. I think we see a lot of insureds actually buying a policy in order to get access to the risk management free services behind the policy, which gives them sort of a free ability to talk to experts and providers and gain certain testing, certain tests that can be run against their system, which sort of tells them what they need to do to make a change. But we also see a lot of carriers offering access to certain vendors for a deeply discounted rate if you're a policyholder. So if you bind a policy with a carrier and we're thinking about using, say, Kroll to beef up some of your controls and security standards, you can actually gain access to a Kroll or someone like that for a deeply discounted rate simply because you bought a policy. So it's kind of a mix, but sort of depends on the individual company.
Okay, we have a pretty good mix of people attending this webinar today, some from safety, finance, C-suite, and IT. Who do you typically find manages cyber risk for an organization?
That's a good question. I think it's a mix. For larger companies, it seems to be a collaborative effort between IT and risk management. If there is someone whose title is Chief Information Officer, or Chief Security Officer, or Chief Privacy Officer, that person seems to blend the line between IT and traditional risk management. In smaller companies, though, it seems to be a bit of a toss-up. There's finger-pointing between IT, maybe a small IT department of only 3 people who traditionally is just working on firewalls and system protection and things like that. They maybe point the finger to the risk manager, who may also be the CFO, and there's definitely confusion over who is going to handle maybe a breach or attack, or whose responsibility it is to understand the strengths of the system. So it's definitely a mix, and I think it's a good question to discuss with an insured is who's going to sort of field the initial phone calls if something happens. Is it the risk manager, CFO, or is it IT?
Okay, well that's about all the time we have for questions. Just wanted to share a couple of upcoming workshops and webinars. We have a workshop called Beat the Insurance Addiction at our Wisconsin location on September 30th. And then 2 webinars coming up in the month of October, Leveraging Social Media to Make Your Employees Your Best Recruiters, and Benefits Communication Bootcamp. So Kevin, thank you for taking the time to share this information with us today. His contact information is on the screen for anyone who has any follow-up questions that they'd like to send his way. Thanks again, Kevin.
Great. Thank you, everyone, for taking the time.